I don't want to seem like a doomster. I think that what we face is easily survivable. But I think the next 10 years are going to be much less benign than the last 40 have been. And I think that in addition to facing real risk, that we're going to face volatility of a type that most investors haven't experienced.
Pleasure to be joined once again by Rick Rule, legendary investor and speculator, former president of Sprott US and president of Rule Media. Welcome back to the show. Always good to see you, Rick.
David, thank you. And thank you and congratulations on the growth of your channel. I've been watching it with awe and interest.
Thank you very much. And it's because of great guests like yourself that the channel has grown. So I appreciate you being here. Rick, I want to talk a little bit about the economy, also about the themes of the Rule Symposium that's coming up later in the month, an excellent conference. But I want to talk about commodities, resources first, the Malthusian theory of the human population running to such an extent that we will be running out of resources, or at least we'll have a scarcity of resources. Is that possible now, that the human race will run out of raw materials to consume?
I think it depends on your time frame, David. I wouldn't worry about it in your lifetime. The Malthusians forgot about something called technology. They thought about the fact that when Malthus was around, as an example, the idea that you could have soil nutrients, that you could look deeper than an angstrom below the Earth's surface. None of those things existed. They also didn't believe in trade. And I suspect that Malthus didn't believe in individual initiative. He didn't believe in the problem-solving capabilities of humanity. I noticed that not only are we more numerous, but we are materially substantially richer than we were in Malthus' time. This doesn't suggest to me that if the Earth's population didn't go to 16 billion as opposed to 8 billion people, that we wouldn't have a range of challenges that we have today. And I think, too, that technology and the increase in material well-being of humankind goes in ebbs and flows. I think, as an example, that 5 years from now, 6 years from now, 7 years from now, and 10 years from now, we will have spot shortages of a broad range of raw materials because we've underinvested for 30 years. I believe, however, that markets work. I believe that if the copper price went from $3.50 a pound to $10 a pound in real terms, that as a consequence of that, consumers would conserve and producers would find a way to make more, and that markets would, in fact, work.
Okay, so can you give us a few examples of these raw commodities that you think might experience shortages? You mentioned copper. What else?
Copper certainly comes to mind, but oil and gas, too, despite the fact that the big thinkers are predicting peak oil in 2032, peak oil demand in 2032. I'm predicting it for 2060 or 2065, trailing off from then. The oil industry on a global basis is underinvesting about $1 billion a day, $360 billion a year in sustaining capital investments. And this is a capital-intensive business. If you underinvest that substantially, you materially impact your ability to produce. Look at Mexico and Venezuela, countries with great natural endowments of oil and gas, where politically expedient domestic spending programs have led them to systemically underinvest in their oil and gas industries, and look at the outcome. The consequence of that is that we will face higher oil prices for longer. Similarly, as an example, in the copper space and in the zinc space, we have underinvested in exploration, underinvested in development, underinvested in construction for a very long time. These underinvestments are exacerbated by increasing political rents. Chile, as an example, is trying to snatch defeat from the jaws of victory by burdening its copper industry. And even in the United States, which proclaims itself to be a free market country, a wonderful copper deposit, the Resolution deposit, 1.5% average grade, 3 times the world average, has been tied up in permitting for 20 years with no end in sight. Now, David, I need to add, we'll talk about this later in the interview, that in the next 5 years, if these supply shortages are met with a global recession, which constrains demand, prices don't necessarily rise. You can have supplies fall if demand falls without having a real price surge. But I think a recession delays rather than eliminates the risk of real substantial supply shortages and price increases in the, let's say, 5-year time frame.
We are going to come back to economic outlook and some of the indicators you're looking at, but let's suppose we do get a recession. Could one make the argument that a recession may actually bring in supply shocks that may push up prices even more?
That could happen. What can happen in a recession is that sustaining capital investment can go away. Or it can be met by increasing geopolitical tensions. That means that even if supplies are available, they aren't available to certain nations or societies. One of the things that's happening is that the globalization that the world has enjoyed, I realize not everyone has enjoyed it, for the last 40 years would appear to be over. And it would appear that both investment and consumption are increasingly being constrained politically, which could, as you suggest, exacerbate these supply issues.
Coming back to the longer term outlook for shortages, could it be possible, all for one more alternative to one consequence, could it be possible that a shortage in, let's say, the oil and gas sectors, for example, could in fact engineer a change in behavior, meaning that it would force us to consume other alternative sources of energy?
Over time, David, markets work, but over time. One interesting example of that is the investments that we've made in alternative energy in anticipation of the end of oil. But many of your listeners will be surprised to know that humans have invested now almost $5 trillion in alternative energies over 40 years. And we've reduced the market share of fossil fuels from 82% all the way down to 81%. We've had a 1% decrease in the market share of fossil fuels with the investment of almost $5 trillion over 40 years. So what you suggest is true. Markets work, but markets are messy and they take time.
$5 trillion over the last 30 years. Let's look ahead over the next 30 years. Rick, do you expect this number to grow substantially, the investment in alternatives?
I do. I think the world is going to need more of all kinds of energy and all kinds of resources. Solar, yep, but not in Germany where the sun doesn't shine. Wind, yep, but not in places where the wind doesn't blow. Coal, I know people hate to say it, but the largest year in history for coal demand was 2022, and 2023 is going to be bigger. Nuclear, yep. Oil and gas, yep. Hydro, yep. Batteries, yep, room for everybody. David, 1 billion people on Earth, 1 billion people have no access to electricity. Another 2 billion people on Earth have access to intermittent and unaffordable electricity. And those societies where populations are growing faster are precisely the societies that are underserved with regards to meeting their citizens' material needs. These trends are absolutely inevitable trends. We've done a great job as a species in the last 40 years, lifting up the poorest of the poor, taking people from desperately poor and starving to merely poor. That doesn't mean that more doesn't need to be done. It does. And that requires more energy sources of all types.
This is one of the themes of the Rule Symposium that's happening later in the month. The themes of this year's conference, would they be tied to what we just discussed, which is the shortage of certain key metals?
Very much. We will offer up a paradigm around the way the world is, rather than the way that the big thinkers would like you to believe. We will offer up the fact that the world is growing and that providing for the material needs of humanity is an important ESG consideration, which means that we'll have wonderful big picture thinkers, but not the kind of big picture thinkers that you would see on CBC or CNBC. Contrarian point of view that is more arithmetically oriented than narrative oriented. Importantly, if you come to agree with that point of view, if As an example, the fact that the market share of fossil fuels has fallen by only 1% over the last 40 years uh, comes to you as being something that's worthy of consideration. We're going to have a lot of analysts and portfolio managers at the conference who have been invested in natural resources, interested in natural resources for 30 or 40 years, not people who learned to spell lithium 3 years ago, but rather people who have made their living investing in money in natural resources through thick and thin for a long time. So precisely the issues that you talk about, and precisely how to make sense of them in your own portfolio, or at least in the natural resources and precious metals part of your portfolios, specifically what the conference is about.
20 years ago, if we had hosted a conference around natural resources, would the theme of that conference and perhaps the focus of specific resources be different 20 years ago than today?
Very much. Different and the same. The theme 20 years ago was the emergence and the urbanization of China. I would argue that when Deng Xiaoping said to be rich is glorious and began the process of urbanizing China, taking 450 million people out of desperate poverty and moving them into this century, that a couple things happened. One, China became structurally much richer as they became marginally less free. At the same time, that consumers in the West met 500 million competitors for material goods. I hope, frankly, for a whole bunch of reasons, that the Chinese success in increasing the material well-being of its citizenry comes to be matched or at least approached by India, by Indonesia, by Nigeria, by Ethiopia. The lifting up of the bottom third of humankind is the greatest challenge that humanity faces, and it's also the area of greatest promise for natural resources. In the West, David, we think of battery materials around what will Tesla's market share look like in 5 years? That's the icing on the cake. Providing basic electricity to 1 billion people and then furnishing their lives so that they can take advantage of the electricity, increasing per capita consumption of natural resources over billions of capitas is the real story.
I have to recall an old Dustin Hoffman movie, The Graduate, in which there's a scene at a party where an older gentleman pulls him aside, the main character aside, and offers him one word of advice, which is plastics. Give us one or few words that will change the way people think about investments over the next coming decades.
I suspect solvency would be one. I don't want to be boring, but the idea that the purveyors of the world's reserve currency have $130 trillion in net present value of recourse liabilities, and they attempt to solve that with a budget that's in deficit, $2 trillion a year. I think that's an interesting one. But I think the most important one, and I don't want to be, I don't want to come across like some sort of granola eater, but I think the phrase that people need to keep in mind is humanity. We need to keep in mind that while we've done a wonderful job increasing the material well-being of the bottom third of humanity, that there is still a job to do. If we allow those people, if we get out of those people's way, they will become more rich and they will want to increase their material standards of living. So for resource investors, at least, I think humanity is a more important phrase than solvency. For other investors, they need to pay real attention to solvency. The paradox that our individual creativity and tenacity so far has been enough to finance our collective stupidity is a wonderful thing, but it's something that scares me on a going forward basis.
What exactly is insolvent, Rick? Are you referring to the Treasury of the U.S.? Are you referring to personal finances, corporations, all of the above, none of the above?
Yeah, yes, and yes.
Okay.
I think that we lived through a time of 40 years, 1982 to 2022, of very benign economic climates, declining nominal, declining real interest rates, relative peace on a global basis, the impact of technology on societies and also people. Again, I don't want to sound like an ESG warrior, but inclusion in the workforce, and the breakdown for a while of economic nationalism, the increase in global trade. I think for the time being, all those things are over. I don't want to seem like a doomster. I think that what we face is easily survivable. But I think the next 10 years are going to be much less benign than the last 40 have been. And I think that in addition to facing real risk, that we're going to face volatility of a type that most investors haven't experienced.
We had economic growth up until now, and now it's going to slow down. What changed over the last 10 years?
I think the most important near-term change has been the decline, pardon me, the rise in at least nominal interest rates. We had a climate where both debt and equity were, at least by conventional measures, at sub-zero levels in real terms. The fact that investors could borrow money for rates that were very cheap relative to the deterioration of the purchasing power of their currency. And thus, as an example, real estate investors could lock in 30-year fixed mortgages where their cost of capital was fixed for 30 years, but they could raise the rent by 3.5% or 4% a year compounding. Their return on capital employed increases while their cost of capital decreased. And of course, the cap rates responded well too. I think that period's over for a while. And I think that people are going to have to adapt to the fact that a whole bunch of circumstances are going to be more challenging. Of course, there will be great opportunities in all of this, but your actions are going to have to be different from the way your actions were. Let's look as an example at the impact of the banking industry on declining interest rates. For 40 years, the banks were able to lend long and borrow short. They were able to have average durations in their portfolio of 6 or 7 or 8 years, and they funded these with very cheap overnight now accounts. When the interest rates rose, two ugly things happened. The yield stream in their long-dated assets fell because the interest rates rose on competing instruments. So the value of their portfolio fell at the same time that the cost of funding it in the overnight and now deposits rose. We've seen this before. It blew up the U.S. savings and loan industry once before. But this whole conundrum of things changing, of people's perception being set by the last 40 years, when confronted with a new reality that's very different, has had real impacts on the market. I don't think that behavior that has been taught over 40 years and a narrative that was created by 40 years of benign times has fully been appreciated by any of the constituents in society. I think the banks are unprepared. I think the government is unprepared. I think the voters are unprepared. I think savers are unprepared. I think borrowers are unprepared. I think that they will adjust, but I think that that adjustment is going to be, to put it mildly, interesting.
Would higher interest rates prompt other opportunities for investors? For example, if we have higher interest rates, wouldn't that naturally incentivize people to save more, put their money in higher yielding CDs or money market funds, or perhaps even the bank accounts that might see higher APYs as a result?
If those higher interest rates aren't accompanied by a faster deterioration in the currency, then the answer is yes. I think that speculators in natural resources, in particular precious metals, need to consider the possibility, however remote, that the Fed will engineer a soft landing, that the relative strength in the economy will continue, but it will be muted to the extent that the deterioration in the purchasing power is less relative to the increase in interest rates, which is to say that we return to a real rate of interest. One of the things I really want to talk about in Boca Raton to people is that the measure that most people, including your government and my government, use to measure inflation is something called the Consumer Price Index. which I would argue is fraudulent. Looking at the CPI as a cost of living index is a mistake for many reasons. One is hedonistic adjustments, which is to suggest that although apartments rents have gone up, that apartments are nicer places to live. It doesn't matter because you can't rent an unnice apartment anymore. So the impact on a person, while it's hedonistically adjusted, isn't real relative to that person's budget. The second is that when it suits them, the big thinkers don't include food and fuel in the cost of living. As you can tell by looking at me, I like to eat and I fly and drive. So food and fuel are relevant to my cost of living. But the oddest thing about that is that the CPI doesn't include the cost of government or tax. The cost of government on the average Canadian or American household is greater than food, shelter, energy, and transportation combined. Now, David, I guess if I didn't have to pay the tax, I wouldn't complain quite so much about the index, but that's not on offer. I suspect, and I'm an old cheapskate, I have everything I need. I don't buy much. I suspect that the basket of goods and services that I consume, including government, not willingly, means that the deterioration in my own purchasing power, denominated in US dollars, is about 8% compounded. So I'm being asked to give the US government money in the US 10-year Treasury, the benchmark savings and investment asset worldwide, and they propose to pay me something like 4% in a currency where I believe my purchasing power is decreasing by 8%. That means that their promise to me is that they will decrease my purchasing power by 4% compounded a year for 10 years. Perhaps the first promise that I believe that my government will fulfill. I think the important part of the lesson is that when you gauge the impact of big picture economics on your own circumstance, that you look at the question very broadly and don't merely consume the measurement index, which is given to you by the CBC or the CNBC or your Canadian government or my American government. You do that at your peril.
Rick, would you, though, rather have that, what you described, or the reverse, which is deflation? You might not see the prices of your goods consumed go up in value, but a deflationary environment may mean that your wages would also deflate, may mean that there would be less economic growth, and thus your purchasing power would decrease for a whole host of other reasons.
Well, David, when you say you need to understand parenthetically that you're talking to an old, fat, bald, rich guy. If your living standard isn't materially altered by your work or your wages, deflation for a guy like me is a very good thing. For society, for a young person like you trying to build your business, deflation is a very bad thing. But you have to be careful who you say you to. My preference, not that anybody cares about my preference other than me, but my preference would be that the government didn't attempt to set interest rates, that they allowed the market to set interest rates, because I think that markets work. They're messy, and they don't lead to outcomes that many people, particularly the less successful people, want. But I don't have to worry too much about that happening.
Long end of the curve, Treasury, 30-year Treasury yields, 10-year Treasury yields, those have more or less stabilized over the course of 2023. They've been trading around a range, meaning they haven't really gone down, which would, right, I guess, signal economic deterioration, and they haven't gone up with the 2-year, which is the shorter end of the curve, which trails the Fed funds rate. What do you think the bond markets are signaling in their economic outlook?
The credit markets are saying we have a recession coming. I mean, pretty clearly, the Treasury markets suggest that there's a recession coming. They also talk to, in a very different sense, the funding strategy of the U.S. Fed, which has been to issue shorter-term obligations, meaning that the Fed has begun to crowd other borrowers out of the short-term market, which is one of the reasons why interest rates in the very short-term market have gone up. I think this is a mistake on the Fed's part, by the way, but the Fed doesn't much care what I think. But I do think that this inverted yield curve is a bond investor's way of saying you need to be nervous about a recession.
Why do you think bond markets are signaling a recession, but not so much the equity markets?
The equity markets may be, if you look at the equity performance in mid caps and small caps, if you look at the equity markets performance anywhere except big tech, the response has been lackluster at best, despite pretty good current economic news and pretty good earnings growth. There is a worrying growth of debt on corporate balance sheets. But a lot of that debt has been spent in ways that support the market, which is to say increased dividend yields or increased share buybacks. But I wouldn't argue necessarily that the equities markets aren't beginning to price in a recession. I just think that given that people's uh, prognostications of the future are set by their experience in the immediate past, the one sector of the market that appears to be bulletproof because of 40 years of performance is big tech. I'm not smart enough to tell you whether those stocks are intelligently priced enough. I don't know enough about technology. I don't know enough about consumer markets. What I do know is that there isn't very much breadth in the market, that the increase that you're seeing, at least in the US indexes, is almost totally a function of 10 big tech stocks and is not indicative of the broad market.
I think you're a very humble man, Rick. I think you've forgotten more about tech and consumer stocks than most of us know since the beginning of this interview. But Rick, let's talk about let's talk about the Fed. In light of your expectations and perhaps the economy's expectations, what do you think the Fed's going to do next?
I think that the Fed is genuinely concerned about inflation. I think if you look at the statements by individual Fed governors, what they're saying is that they can't count on the political establishment in the United States to control spending. And as a consequence, that inflation, if it's going to be dealt with, needs to be dealt with by the Fed. The Fed has acknowledged that there will come from time to time circumstances like the banking crisis where the Fed will be required to create specious currency units, which is to say counterfeit, do quantitative easing. And the consequence of that is that the only instrument that the Fed sees available to taming inflation is an increase in interest rates. I believe that the strength in the economy and confidence in equities markets, debt markets, and the economy is strong enough that the Fed can and will increase the interest rate at least twice more.
That is what Jay Powell has been signaling. Is that sufficient then to finally beat inflation? And by inflation, I mean specifically the core PCE number, which thus far has been sticky around 4.6%.
Yes, I think it is. I think that's a misstated measurement matrix, as we described before. I think what that number is a confidence number. I think it's a sort of a made up statistic, but its use is ubiquitous enough that I think that they may well be able to engender a sense of well-being by bringing this measurement metric down enough that they convince savers that they're getting a real yield, even if that real yield assumption is specious. I think that the problem with the increased interest rate will come in devastating the long bond market. The idea that as you raise the interest rate, you lower the price of an earning stream in an existing long-term asset, say a 30-year mortgage, at the same time that you raise the funding cost associated with it is really problematic. David, if you, rather than running the David Lind report, were the portfolio manager for the University of British Columbia Endowment, you would truly be between a rock and a hard place. 40% of your assets are in instruments that worked well for 40 years, but aren't working well now. You are responsible for ensuring the well-being of the institution and its students 20 or 25 years from now. But 40% of your endowment is in long bonds, and an increase in the interest rate uh, causes the value of those long bonds to go up. Now, you report this to the chancellors and tell the chancellors that they need to make immediate contributions to the endowment. And they say to you, David, using what for money? Our actuarial assumptions are based on a 7.5% compound yield. And we have a 3% loss. We have a 10% funding shortfall, and we can't meet it. On top of that, the deterioration in the real purchasing power, not the nominal purchasing power, of the distributions that you, as the portfolio manager, hope to enjoy 20 or 25 years from now, will not keep pace with the increases in inflation at the University of British Columbia. You are going to have to do something with that 40% of your portfolio that has provided the easiest performance of any asset that you manage over the last 40 years. It's going to be a real challenge. Be grateful that you are doing the David Lind report rather than being portfolio manager for the University of British Columbia Endowment. That's really how I think about it. There is going to be, I think, severe disintermediation in the long bond.
Do you think maybe just going back to the example of the portfolio manager, do you think that there's maybe a mismatch between their short-term and longer-term mandates?
Well, an inescapable one. The short-term mandate from their employer is make sure we don't have to contribute too much. Because if we contribute too much, we have to take it out of current benefits and salaries to the existing staff. Almost all professionals, I'm afraid, favor short-term gain over long-term pain.
I ask this because I wonder how much of this equities rally that we've seen was due to the fact that many large institutional funds don't allow managers to short. Is that a reasonable assumption to make, that some of it has to do with mandates rather than expectations?
I think it's more expectation. I think after 40 years of benign economic climate, that they're disinclined to short. I think that they'll be attracted to the short side of the trade when there's no value left in it, when the performance of the short trade has been demonstrated so clearly that there's no longer any value left in the trade. I'm afraid I think that it's herd mentality more than anything else.
Circle back on inflation. If I were to make the statement that the collapse of certain raw commodities, lumber, natural gas, copper, just to name a few, the prices have come down dramatically over the last couple of years, or this year, relative to the last couple of years, rather. If that were to signal lower inflation ahead, would you agree or disagree with that statement?
I think it signals a fear of recession. I think the normal near-term impact of a recession is declining inflation. I think the policy response to a recession would be highly inflationary. In my lifetime, after 1982, every economic hiccup that we experienced resulted in an increase in quantitative easing and a decrease in the interest rate. I think that the voters have come to believe that we can't tolerate recessions anymore. I sort of believe that they're a normal and natural response to markets. So it'll be interesting to see how that plays out.
And in light of this coming recession, what do you think are good plays for investors? What has traditionally done well during recessions is really my question.
I'm maintaining cash as an important component of my portfolio. I know it sounds like I'm schizophrenic. I'm maintaining a large amount of an asset class, which is decreasing my purchasing power on an ongoing basis. I do it because I've lived through three real liquidity squeezes in my life. And having cash when nobody else has any sometimes gives you the courage when nobody else has any, so that you can take advantage of a liquidity squeeze rather than being taken advantage of by it. So I'm prepared for, I can't guarantee a recession, but I can guarantee volatility by increasing my cash position. I'm also, partially as a consequence of entering retirement, confining all of my investments to sectors that I know very, very, very well. I want to compete based on my own expertise. I have absolutely no fear of missing out. So I have absolutely no interest in going to asset classes which might do well, but are, given my own lack of expertise, speculative. I My own portfolio is beginning to look like a barbell, which is to say, some of it, a lot of it, is in the biggest and best, the finest, the most muscular companies in the sector, where I'm hoping to achieve both market beta as demand for raw commodities increases, but also stability and current yield, which is to say dividends. On the other hand, I'm speculating in smaller companies where I believe my patience, my willingness to hold them for 5 years, my acceptance of volatility, and my willingness to understand companies on a micro level will give me competitive advantage over people who have exited the microcap space in earnest. So I'm doing both of those things, perhaps more in response to my own capabilities or lack of capabilities than I am in anticipation of a recession or some other outcome. I don't believe that anybody, myself included, has a 2020 vision into the future. I believe that life is about anticipating possibilities and probabilities and organizing one's portfolio in a way that will make you as comfortable as you can be in a broad range of circumstances. And that's what I've tried to do.
I've been hearing from some people that going into this economic downturn or recession, oil may go to triple digits. Is that a view that you share? Is that possible?
I think it's less, yes, but I think for different reasons. I think it's the lack of sustaining capital investment in the oil business. The oil industry worldwide is underinvesting in sustaining capital to $360 billion a year. That's not the way you generate more supply. Your prime minister doesn't seem to understand the business case of exporting Canadian natural gas to willing customers. And my president, while he's asking the oil companies to produce more oil and bring down the price of gasoline, is telling them that he's going to put them out of business in 2030. There's not an investable category. Now, talk about schizophrenic. Invest tens of billions of dollars to bring down gasoline prices and then have me confiscate the money. I shouldn't laugh. This is serious stuff. But the dichotomy is so apparent to everybody but Biden that's laughable.
What is the consequence of these actions by politicians on the regular consumer?
It's horrific. The oil price doesn't need to be this high. If the big thinkers of the world would acknowledge that demand for fossil fuel will continue to grow and the demand for all energy would grow, if the politicians weren't actively trying to discourage the provision of debt to the oil industry by big institutional investors, if they weren't trying to talk down oil and gas equity markets, if they weren't trying to constrain the oil and gas industry by regulation, they could bring down the cost of the lifestyle that we all aspire to markedly and in real terms. There seems to be an unwillingness among the political class to deal with the fact that, irrespective of their preference and irrespective of the preferences of some of their large donors, that when most of the world, David Lynn included, walks out to the garage, turns the key to the right, he would like his car to start. I think there's an increasing skepticism among voters about the irony of 1,000 people taking private jets to Davos, where all those folks get together and tell you to drive less.
Do you see any sort of soft landing scenario, quote unquote, for the energy industry? Meaning that if we were to transition to alternative sources of energy, could we do that without harming the consumer through underinvestment in the oil and gas sectors?
Not in 40 years, not in the next 40 years. Remember that not you and I, David, but somebody in Malawi has in one generation made the progression from starvation to a reasonable diet. They've made the progression from barefoot to sneakers, sneakers to bicycles, bicycles in some cases to 50cc motorcycles. Now they want to move up to a Hilux. They are, that person in Malawi, very, very, very unconcerned about your aspiration for them. When we have the whole carbon debate, because I know in the discussion that will follow, in the social media discussion that will follow our discussion, that I'm going to get a bunch of the well-meaning granolas to talk about carbon. I want to talk about carbon from the point of view of a very poor person in an emerging market. In those countries, they believe that carbon emissions shouldn't be measured on a national basis, that they should be measured on a per capita basis. In other words, the more people, the more carbon, the greater the carbon allowance, because it should be measured per capita. It's tough to argue with that. They also believe, and I'm sympathetic, that when you're measuring carbon, given that 95% of the carbon in the atmosphere from human sources is historic loadings, that people in frontier and emerging markets should get a credit, and people in developed markets should get a debit, because most of the carbon that's in the atmosphere was contributed by the rich, decadent West. Which means that if we are going to achieve the goals of the carbon initiatives, which, by the way, we aren't, that the overwhelming cost of doing that will be absorbed by consumers and voters in the rich West. And I have a bit of experience with those voters. I've been one and I've watched them for 50 years, and they ain't going to eat the tag.
If the entire world were to converge on the single goal of reducing carbon emissions down to zero by, I think, 2050 is a stated goal of most governments, what needs to happen if we were to reverse engineer this result?
You need to add to if the tooth fairy came down to earth and gave us enough money that we could afford to do this. I mean, I love your ifs, but it ignores the time value of money, and it ignores technology. So yes, if night were day, solar would work. But you've given me an if that can't be part of the equation because it's not. Listen, I'm not anti-wind. I'm not anti-solar. I'm not anti-battery. I'm pro all these things. I've just learned over time that I need to constrain my investments with arithmetic.
Speaking of investments, let's close off on this. You used to offer a tremendous service, which is to rank people's portfolios. Do you still do that?
My favorite thing to do. I learned so much by teaching others. Any of your listeners who come to my website, Rule Investment Media, and list their natural resource portfolios, I'll rank those personally 1 to 10. And I'll comment on individual issues if I think my comments might have value. That's ruleinvestmentmedia.com. List your natural resource stocks, and I will value them. By the way, one more commercial, if I might, David. I'm celebrating retirement by starting a new bank, as I think you know. If any of your listeners, I did it once before, by the way. We did a highly successful thing called Everbank, which we took from 0 to 28 billion before selling it. We're going to try and do that again. So anybody who isn't as comfortable as they might be with their existing bank, Canadians as an example, who didn't like the fact that Mr. Trudeau could freeze their accounts if he didn't like the way that they voted or contributed. Anyway, in the question and comment section at Rule Investment Media, the same place that you list your natural resource stocks, write bank. The big part of the offer, of course, is, I'd love to help you rank your natural resource stocks. No obligation. I'm not a broker anymore. I don't do any of that kind of stuff. Please no tech stocks. Please no pot stocks. Please no crypto. Leave an old resource guy to what he does.
Rick, you're like the movie that keeps giving us sequels. Every time we think the trilogy's ended, you give us another episode. We think you're retiring, but then you launch a new venture. Okay. I'm curious as to why you're starting a bank. I mean, what's incentivizing you to? Clearly, you see something wrong in the banking industry.
I love the banking industry. I'm best described, I think, as a used money salesman. If you keep your life simple, which is to say, you look after the interests of depositors and you look after the interests of borrowers, and you do that with reasonable acumen. You don't do anything stupid. You don't get too over leveraged. You use derivatives if you use them to hedge interest rates, but not to speculate in derivatives. If you understand something about the collateral that you lend against, life is very good for you. I've done this before to great success. Our bank, Battle Bank, will offer people one savings product, not 15 savings products. So if you want to write checks against it, you do it. We will pay in the highest quartile of deposits in the United States. We will have money market and CD accounts in 20 or 22 currencies. So if you're a Canadian, as an example, that exports to the United States or imports to the United States, you can maintain Canadian and US dollar money market accounts, and you can switch between the two for minimal rather than maximal fees. On the asset side of our ledger, we're not going to try to be all things to all people. We're going to do stuff that we know how to do. One thing we know how to do is precious metals. If you maintain precious metals in a segregated account in the United States or Canada, we will lend against that. We think precious metals are good collateral. We will only do 6 or 7 things in this bank, but we will do them as we did them before, very, very, very well. I'm in this business, David, because I'm an entrepreneur. I can't help myself. I see a hole in the market. I want to fill that hole. I have a relationship myself with 3 financial supermarkets, great big banks. And I have to describe my relationship with each of them as sullen, but not quite mutinous. I want my relationships with my banks to be ecstatic, not sullen. I know for sure that I can't compete with Bank of America. I can't compete with the Royal Bank of Canada. I can't compete with Hong Kong Shanghai Bank, but they can't compete with me either. And I want to deal with that part of the market where I don't merely beat them, but I beat them decisively.
Okay, just on this note, I'd like to ask you whether or not you can compete with Apple computers, because Apple has recently launched a new high-yield savings account product offering, I think, 4.15% APY. I think this is a very narrow banking solution. They're not offering a lot of things. It's just savings account now for Apple users. What do you think of tech companies moving into the banking?
For what they do, it's great. We need more people doing it. The value proposition for Apple is very simple. Be a vast deposit-taking institution that has very, very, very low fixed costs, no branch. Your phone is their branch. And then reinvesting the money in short-term treasuries or in repos offered by other banks. In other words, taking the money at 4.1% and put the money out at 5.1% and live on a 100 basis point spread over $1 trillion. Our value proposition is very, very, very different from that. We aim to service specific niches, first-generation business people that do business in multiple currencies in multiple countries, people who want to diversify their cash assets among various securities. We will not only lend to the U.S. government and other banks. We will lend against industries that have greater spreads where we understand those industries extremely well. Can I compete with Apple? Nope. Can Apple compete with me? Nope.
I understand. I wanted to ask you about the lessons you learned from analyzing people's portfolios and their stock picks or the strategies, if they have one. What are some interesting quirks of investors that you've noticed over the many, many years of which you provided the service?
I'll leave you 3. The first is that most investors own way too many stocks. I ask people, particularly speculators, to own the number of stocks that corresponds with the number of hours per month that they spend on their portfolio. So if you spend 10 hours per month studying your portfolio, then you can own 10 stocks. I would say that most investors who spend 10 hours own 30 stocks. The The second thing I'd say is that while most people regard themselves as cautious and conservative investors, in truth, they're wild ass speculators. There is a preponderance to microcap names, irrespective, I think, of the category that the investor overall is interested in. While I ask people to send their resource portfolios, they send all kinds of portfolios to me, which suggests that people are much more speculatively inclined than they think they are. The third thing that I notice is that even resource investors who should be contrarian aren't. I notice, as an example, between now and 7 years ago, when I first started offering up this service, 7 years ago, when, as an example, lithium was very cheap, lithium stocks weren't in portfolios. Now that lithium is up 400% in price, and now that the number of purported lithium companies has grown from sort of 10 to 200, it's in every portfolio. So I would argue that investors are unfortunately anti-contrarian in a deeply cyclical sector, that investors are much more speculative than they think they are. I'm not saying speculation is a bad thing, David. I made the money that I invest cautiously by speculating wildly, but I got lucky. And I think, too, that most people own more stocks than they could rationally follow.
One could argue that if you own the index, you're owning too many stocks and you can follow. But that's a different type of investing strategy. The efficient market hypothesis, what do you think of that? It broadly states that, I'll let you respond.
You have me in dangerous territory because I'm the largest shareholder of Sprott, who sponsors ETFs. I guess for an investor who believes in market beta in a sector and is too busy earning a living to study stocks themselves, that ETFs fulfill a normal function. I personally would rather own the 5 best companies in a sector, even if I underperformed the index a little bit. By owning better companies, I lowered the risk associated with single company failures. When I look at sectors I know well, like the gold sector, an ETF that's constructed purely around market cap and liquidity means that I pay the ETF sponsor a fee to own an index of 40 companies, 25 of which I wouldn't own with my own money. So I'm paying a fee to own stocks that I wouldn't otherwise own. Now, for an investor who has a life, not Rick Rule, but rather an investor who has a life, who wants to spend time with their kids and their grandkids, wants to fish, has to work, wants to read, I get the ETF thing. There's just something that's inelegant to me, paying somebody a fee to manage my money, owning stocks that I wouldn't otherwise own with a straight face.
Well, there's also the diversification argument, which is that what if you're wrong? I'm not saying you are, but what if you're wrong about the stock that you know well? At least there's something else to hedge you.
And, if you look at the second factor that I cited, which is the fact that most people own way too many stocks relative to the time and effort that they spend on the stocks, your concern, your comment there is very well founded, David.
Yeah. All right. Excellent. Rick, thank you very much for a very thorough discussion as always. Good to see you. And we'll put the links down in the description to all the sites that you mentioned where people can follow your work. You're also active on Twitter, so we'll put the link in that description as well. Best of luck to your upcoming conference and to Rule Investment Media.
Pleasure. Thank you for having me back on, and congratulations again for the growing audience of the David Lind Report.
Thank you very much. And thank you for watching. Don't forget to subscribe.